sort of sitting out there, the next question is, what is tax planning? It's something we spoke a lot about, and today's session is obviously about things you can do for tax planning. But what is it? Well, as basically, it's managing your tax affairs. And even the ATO acknowledged this. So you can see on their website there, the ATO says you have the right to arrange your financial affairs to keep tax to a minimum. This is often referred to as tax planning or tax effective investments. So tax planning is a perfectly legitimate legal way of reducing your taxes. Tax is one of the most expensive costs of business. We want to call it that. 25, 30% of your profit can go in tax, which as a percentage of revenue can be quite large. And so it beholds all of us to manage our tax affairs in such a way that we're not overpaying tax. Now, there's always a fine line here between paying, tax planning and tax avoidance. Tax avoidance is deliberately, skirting the rules. Tax planning is playing within the rules. And so, as long as we play within the rules as set by the ATO, and I will say, of course, that the rules change all the time, but as long as you're playing within the rules, you'll be fine from a tax perspective. A basic rule of thumb that I use for all our clients for our businesses is that if you take profits out of your business, you're going to pay tax on that. All right. Most businesses operate through a company structure, although businesses do operate sole traders and trusts and others. If you take profits to spend, okay, so that's what it is. It's taking the cash out of the business, taking the profits out of the business, and going to consume. And look, we've all got to live, we've got to pay mortgage payments, we've got to buy the groceries, clothes, holidays, etc. That money is all going to have a tax consequence when you do that. All right. And so it's a taxing point about what time that happens. And so this is why planning up front is really important for your longer term business, because you go to yourself, well, how much cash do I got to retain in my business? How much am I going to take out? And what are the tax consequences thereof? And that's kind of what we're going to go into next. This year, though, in particular, there's a few key changes. Now, fortunately, or maybe unfortunately for us, the budget that was done 2 or 3 months ago was pretty much a nothing affair. Obviously, with election imminent, the Treasury was forced to do, or Treasury was forced to put through a budget. There were no changes. The election campaign was fairly boring as far as tax goes, and only a few minor tweaks, which we'll touch on those in a second. So, key ones to think of for this year round. Firstly, instant asset write-off. This is if you're a small business for a capital expenditure under $20,000, you get an instant tax deduction for the full amount. Now, this is actually a year-by-year thing. The legislation is set in Parliament at a very, very, I think it's $500 off the top of my head, very small amount. And every year the government has to pass new legislation to keep the number at $20,000. Bugbear of mine is why they simply don't change the law. I don't know, but they don't. So luckily this squeaked through back in just before Parliament rose. And so we're in for another year of $20,000 instant asset write-offs. And we'll talk a bit more about that later on. Second big change, which this impacts quite a number of clients, but in different ways. The GIC is not deductible. So GIC is general interest charge. And so if you've effectively borrowed money from the ATO, like if you've got outstanding tax debts with the ATO, the ATO's always hated being treated like a bank. I remember seeing the Commissioner of Taxation talk at a conference a year or so ago, and that was literally his comment. Don't like being treated like a bank. So what they have decided is that general interest charge will no longer be tax deductible. Now, general interest charge, I think, is around 8% at the moment. What that effectively does is that pushes up the cost of borrowings because you won't get a tax deduction for it. And so for a number of clients we have, and I know there's no people in the situation where they have payment plans in place, that interest you are paying is not tax deductible, unfortunately, from 1 July going forward. Something to bear in mind, especially if you've got cash flow issues throughout your business, because and the ATO, it's a common theme. I'm going to touch on again in a second. Is that during COVID, the ATO really stopped any real enforcement actions. They were very lenient on collecting cash from business over those couple of years. Then about 18 months ago, they've ramped up their enforcement actions again. And so it will only get worse the coming year. The ATO there is billions and billions of dollars in outstanding tax payments due to the ATO, and they are getting more and more tight on collecting their cash. Now, as a small business, that obviously causes problems because we've got to make our tax payments and we've got to make them on time. But sometimes businesses go through ups and downs, and sometimes you're having a down. It's helpful to be able to defer payments. Um, and so one uh, one thing using a payment plan, for example, might be a helpful cash flow management tool. But general discharge not being deductible is going to make that just a little bit harder. Okay, the third key change coming up, and this is for 1 July next year, is payday super, which this is more a be ready for this. It's not here yet, 1 July 2026. But what this basically says is you have to pay your superannuation for your employees on the same day or within a week, but basically on the same day as you make your salary and wage payments. Okay. At the moment, most superannuation is due to be paid quarterly, so the following quarter. So the March quarter payments are due in April. That will change. And so there's a piece of work going on at the moment now with Treasury and the accounting bodies and tax bodies and others to look at how this is going to work. But from a small business perspective, this will impact your cash flow. Again, I know a lot of people just delay the super payments until the date it's due, but that will be a no-no from about 12 months out. So this has questions around your working capital. Do you have enough cash retained in the business over the next 12 months, 12 to 18 months, to be able to pay superannuation as and when you pay your salary and wages to your employees? Okay. They're three key changes. Coming up with a couple of question marks. Now, these are things we think are happening. They've been spoken about a lot, but they're not legislated yet, or they're not rules yet. First one is Div 296 tax. So this was bandied around for a couple of years. This is superannuation balances over $3 million and having an extra tax, 15% tax on top of that amount, over $3 million. The Greens want 2, ALP wants 3. We'll see where that negotiation lands. But there's quite a few people out there with balances over $2 million. Not so many balances over 3, but there are quite a few superannuation accounts with balances over $2 million. The issue here isn't necessarily the tax, although that's one question. The issue here is actually taxation of unrealized gains. And I'll give you a quick example. We'll obviously touch on this in the future when it becomes, if and when it becomes law. But let's say you've got a balance at the moment today of $3.1 million. Share market goes up, your investments goes to $3.3 million just because of share market movement. So you've got $200,000 in unrealized gains. This legislation taxes that unrealized gains. And the question is, how do you pay for it? Because you haven't got the cash, you haven't sold the investments. Second problem is, if the value goes down again, do you get a refund? I don't think so. I'm not sure, to be honest with you. And so there's a few consequences like that that are a bit nasty. But it is unprecedented, taxing unrealized gains. Nowhere else does it. And so it's kind of a watch this space. Okay, next one down, taxation of trusts. It's a Treasury favourite. It's the sort of thing that the ALP and the Greens would put through. But actually, tax at the moment, Australia is one of the few jurisdictions in the world where trusts aren't actually taxed. And so I suspect this will be coming. This is the sort of thing, like I said, that just politically makes sense for parties of the left to try and do. It obviously has massive consequences for every small business because a lot of businesses have assets in trusts, and there's great reasons to do that. But the tax consequences of taxation of trust would be quite horrific, I think. But that's just a warning. All right, next one down is this is an ATO thing. Clamp down on late lodgements and late payments of BASs. Now, the ATO, I've seen a few of these happen already. If you lodge your BAS late repeatedly, the ATO will flip you from quarterly to monthly automatically. And I've seen a few of these happen already, perennial late lodgements of BASs. So again, it's one of those ones. Now, there's nothing necessarily wrong with lodging monthly. It may actually have some benefits in terms of cash flow. But again, it's one of those ones that from a working capital perspective and a cash perspective, if you're not ready for it, can cause a bit of grief. But that's definitely here and now and happening now. Okay, ATO enforcement, as I mentioned, there is billions and billions of dollars of unpaid tax out there at the moment. The ATO is going hard for that money. Director penalty notices are a tool they use. This makes directors personally liable for the debts of companies. And again, they're pretty nasty if you get one of those. So again, if you're behind in your tax debts, come talk to us. We can talk about ways of managing those affairs for you, or with you, sorry, and ways of approaching the ATO. But you definitely don't want to get a DPN if you can avoid it because the consequences can be quite nasty. All right. The other thing that the ATO has been talking about a lot recently is succession planning, family trust elections. There's trillions of dollars of generational wealth being moved from the boomer generations down to children and siblings over the next 10 to 20 years. And so the ATO is looking at this area very, very carefully. One thing that I've seen in the press in the last week or two, there's apparently a family group out there somewhere who's sorry, a family trust. These are again most it's a tax concept. Um, Allows you to distribute within a family trust, within a family group, um, but not outside the family group. And there's good tax reasons why you would or would not do that. There is a case, or there's a pending case, perhaps, or an issue at the moment with a certain family group. I've seen in the press who owe hundreds of millions of dollars because I got this wrong. That's obviously an extreme case, but the whole area of succession planning, the whole area of uh, shifting assets between family members is an area the ATO is looking at really closely. I'll also add in there, which we'll cover off later, is Div 7A as well, is an area that we're looking at closely. Okay, the last one there, an ALP campaign promise. One of the few tax promises they actually made, $1,000 automatic deductions for individuals. Now, I don't think this is the dumbest idea, actually. I think this is a rather clever thing. Australia, again, is one of the few jurisdictions in the world where everybody lodges a tax return and everybody, not everybody, but a lot of people use agents to lodge tax returns. If you go to a lot of different countries, the UK and New Zealand being two examples, you are simply assessed with an automatic standard deduction, and the tax jurisdiction or tax departments in those countries give you here's your refund, accept it, or press here to go and lodge your own return with with the right numbers in it. So like a lot of compliance resources, a lot of accountants resources are tied up doing these sort of basic personal returns. I don't understand why the Australian tax system is quite complicated. Um, Hopefully, this is a good step towards meaning that a lot of people can just simply accept their refunds and don't need to go and see a tax accountant each year. I say that obviously with vested interest being a tax accountant myself, but I think our resources are better off spent and our time and efforts are better off spent helping small business grow, helping our more complicated clients with more complicated tax issues rather than doing the basic returns. And so we'll see if this gets up. Like I said, it was a campaign promised by the ALP, $1,000 standard deduction. You don't need to, according to the ALP press release, you don't need to keep any records. I said it wouldn't be the dumbest idea that's come out of Canberra. And so I think it's one of those ones where like, if it gets up, it would actually be a benefit from a reducing red tape and administrative perspective. The last thing I'm just going to touch on is actually not on the slide, but again, just to be aware of, there's been some big changes in how the tax industry is being monitored. TASA, Tax Agent Services Act, has changed with a business unfriendly government. The clampdown on tax agents has really took, it was really quite strong mid sort of 18 months ago, thereabouts. Consequences, it makes the way we operate with our clients as tax agents just that little bit harder. Compliance costs are going up because we have to do more compliance work to support our clients. Good or bad, I'm not here to judge. It's just the way it is.